Okay, perfect. I think we are live now. We're a minute early, so we'll go ahead and give some time for everybody else to get logged in. And Andy, while we're waiting for everybody to log in, where are you joining us from today?
So I'm actually in DC. I'm not in DC, but I'm really close to it at the National Harbor in Maryland.
Oh, yes.
So beautiful, massive hotel, the Gaylord, right on the harbor. And it's a beautiful sunny day here, a little bit cooler than where I live down in North Carolina. But, there is a lot going on in DC and a lot going on in Washington, DC with all the policies that President Trump is trying to bring about. So it's fun being here to meet with people and talk with clients and former colleagues and so on. So it's crazy times.
Well, there's probably a number of people on this call who were just at the Gaylord in our industry. The NMHC, National Multi-Housing Council, puts on an event every year called OpTech, and it's specifically regarding technology for the industry. And in, I think, end of October, beginning of November, it was at the Gaylord. So a number of us from the industry were all just there. It really was a great place to have a conference.
Yeah, it's mass. It's just, the Gaylord, I've been down to the ones in a bunch of different cities, a bunch of different parts, different states, but this one's got one of the best views ever as you're looking out over the harbor. You can't go wrong with that. So that's great that everybody was here recently.
Yes, of course. Well, while we let everybody get joined, let's go ahead and dive in to just some quick audience notes. I want to make sure we don't have I think we're having a little bit of delay. For some reason, we're not getting through the slide deck here. There we go. Okay, it was on a little bit of a delay. So just some audience reminders for everybody that is joining us here. If you want some more insights, I believe it is right below Andy and I. I think if you look at your screen to your left, I have a feeling it's right below us, where there are some PDFs that have some great information for everybody. Also, please do go ahead and chat. Let us know who you are, where you're from, what's top of mind for you today. We will be glancing at the chat, pausing throughout to answer any questions. So please go ahead and communicate in there. And there's also a Q&A box if you want to go ahead and put questions there. So let's go ahead and get started. We are 2 minutes past the hour. I am Natalie Cariola, the Chief Revenue Officer here at SmartRent. I have spent my entire career in real estate technology, and I'm also a multifamily investor. So I'm incredibly excited to hear what Andy is going to share as an investor myself. I am joined by Andrew Busch. He is an economic futurist. He has a great perspective. He cuts through chaos. He has actionable insights. He has a rare ability to make topics clear, engaging, and fun, which is what I think we are all looking forward to in the next hour. And Andy, I'd love for you to take a minute, just give us your baseball card stats and let us know why we should be excited you're here today.
Oh, okay.
The pressure's
elevator pitch
on.
of Andrew Busch. Yeah. Hey, I've had some really fun jobs over the years. I was a currency trader for a long time. So from that, I learned very, very quickly that international matters matter. And so does Fed policy because it impacts the value of currencies. And basically, so does everything. So I've had an interesting career. I did start off trading currencies, and then I segued into, in about 2007, I became Bank of Montreal's global currency and public policy strategist. And then I left the bank and started my own company in 2013, ran that for a while, and then I got a wonderful opportunity to work in government as the nation's first chief market intelligence officer during the Trump's first term in 2017. So I had a team of 40 researchers analyzing the markets. My job was to direct them and then take all of that information and share it with Congress, the White House, Treasury, Federal Reserve Board, all these different groups. And then I left there and restarted the company in 2019 and have been running it ever since. And basically, my company, we create a lot of research covering, AI, politics, policy, the economy. basically everything that drives value in the economy overall and in the markets. And so it's been a blast to do this. My clients cut across the entire spectrum of the economy, whether it's construction, whether it's architecture, whether it's agriculture, there's just everything. It's so much fun because I get a chance to talk to CEOs in all of those spaces, and I get to learn from them and then bring that to every client meeting I have. So it's been a great journey so far, and it's really just, even with the chaos today, it's been a lot of fun.
Well, I appreciate the background, and it sounds like you've talked to some pretty powerful groups in DC. Now you get to talk to some pretty powerful groups in the real estate space, and we're really excited about what you're going to bring to the table today. I think I'll throw you a softball one to go ahead and start, because you are speaking to a number of multifamily owners and operators. So tell us about your first rental experience, or maybe your last, maybe your last rental experience.
Well, I'll talk about the first one because that was kind of fun. That was back when I was in college, right? I rented the first floor of a house from a college professor, right? I had a buddy of mine that we were going to move in there. And then right before we moved in, he said, you know what? I'm not gonna rent with you. And so I had to rent the whole first floor of a house myself. And so that was a bit of a shock to the pocketbook, as you can well imagine. Yes. So that was my first experience when it comes to renting. I did own another house that I did short-term rentals on, and I can tell you that was not fun because we ran it ourselves and we really had to monitor people because it was in a vacation area. And, all the crazy stories that you hear about people doing bad things in your house, well, a lot of those came true. We had, we tried to make sure that we didn't have, college kids rent our house. And so what ended up happening is their parents would rent it. And then, so we had a Ring doorbell. We didn't have a camera inside, but we had it on the outside. And so one time we're kind of watching all these kids start to come into the house. And then, of course, they're bringing in kegs, right? So we had to run, over there 2 hours away and kind of stop them. But, they did things like, I don't know, take off the door to the supply, cabinet. So we learned a lot from that experience.
Wow. I think this is why I choose to invest in multifamily and let the professionals do the operating for me so that I don't have to. My most recent experience, actually, I just moved to North Scottsdale when I took this role with SmartRent. And so I had a very recent experience. And I think for me, one of the things that was most surprising is how little the process has changed. You would think with how much technology we have now that you would think my experience would have been wildly different than it was in my early 20s. And surprisingly, it wasn't all that much different. And so I think that's actually a great segue into, for the audience here, we actually have a poll for you. And this is specifically around technology and the economy, which is, given the current economic climate, there's a lot of uncertainty. Please, everyone, check your answers. I am curious how willing you are to invest in new technology in 2025. And so, Andy, while we're waiting for some answers, I'm curious from you, given how uncertain the economic climate is right now, what do you think? Do you think people are investing in technology? Do you think they're only doing it if it replaces a current spend? What's your take?
Well, I mean, this is challenging times, to be sure, for a number of different reasons. I would say this. People who are forward-looking should be investing aggressively in technology. And the reason is primarily because it increases productivity and it increases efficiency. I always talk about PE firms, right? And so I always have a picture during my presentation of an alligator. And people are looking at it like, why do you have an alligator? And I get them to think about the alligator's mouth. And I'm like, why do PE firms talk about an alligator and why do they want that mouth? So, why do they want it open? And the reason is because they're talking about dropping your expenses and raising your revenue so your profits are big. And that's the opening of the alligator's mouth. And that's what technology does. And really, that's what AI does. And so we spend a lot of time walking audiences through those two things. But I think that's the key. As we do not have maybe the labor force that we want all the time, technology can replace a lot of the functions of labor that we need to replace that could be replaced? Can you eliminate having always to run over a key to somebody to get in the door, right? That kind of stuff. Also, maintenance, when it comes to AI, do you have sensors on your HVAC that can give you a heads up when your HVAC might be on its last legs? And if so, then you could do, predictive maintenance and preventative maintenance to go ahead and get that thing replaced. So from that standpoint, from what I see and how I advise clients is like, you have got to take advantage of this as much as possible, as much as your pocketbook can allow you to, because if you don't, you're going to run up your costs overall, and then you're also not going to be competitive with other people, and you'll probably have to keep your rents higher than you normally would. So that's something I think is interesting for everybody to consider.
Yeah, I think that's a great take. I am curious of what people said, because I have a feeling what you said makes perfect sense, which is invest in technology ultimately to run a more efficient business. And yet I still think people oftentimes are very scared to spend money. So let's go ahead and see what our group said. And so let's see, we do have 23% that are increasing their investment. So Andy, it looks like about a quarter of the people are with you on that it's worth investing in. Over half actually went to the direction that I was thinking they might, which is only if it's actually going to save me money or if we can get a rev share opportunity. Another quarter basically said we're only going to do it if it replaces something, which makes sense. I'm incredibly happy to see, though, that not a single person is holding off on new technology. So I think that's great. And so I think that brings us.
I just want to jump in and say I totally get the ROI, and that's really important overall, because there's a lot of examples in the world of people who had a solution to a problem that didn't exist, right? And so then you end up spending money that you don't need to have wasted, right? I think everybody who's had their careers for a while has done something like that. They're like, oh, this is going to be great, and they really haven't thought through what it means for the business, how you're going to monetize it, and what the rate of return is. So I think that's your audience is picking up on that. I'm just really glad to see it.
Absolutely, and I think this does bring us into. Let's talk about the obvious, which is the economic climate, right? And the time of this this webinar is very timely, given yesterday, the Fed meeting. I thought it was a little interesting, the mixed signals where they said, yes, we're still anticipating 2 rate cuts this year, yet it's already almost the beginning of April, and then followed it up with, we really don't have any idea what's going to happen with the economy. So I am interested, what is your hot take on what happened yesterday?
Yeah, so it was interesting, wasn't it? First of all, the Fed downgraded their assessment of the U.S. economy for this year. They dropped it by 0.5 percentage point. They had 2.2% GDP growth previously. Now it's only 1.7. By the way, that mimics and mirrors also what companies like Goldman Sachs did the exact same thing about a week ago. So obviously they were talking to the Fed. But Fed has also said that they expect the unemployment rate to go up from 4% to 4.4%. And so that's about a full percentage point off the low of what our unemployment rate has been. And historically, if your unemployment rate goes up by a full percentage point, typically, on average, you go into a recession at some point. I don't think that's the case for this right now, but it adds to some of the uncertainty that the Fed has. And really what they said, just to condense this down, is that they don't know what the future path for the economy is because they don't understand President Trump's tariff approach. How long will these tariffs go on for? Will they last a long period of time? If they stay on for about 5 months, then you're going to start to see a deterioration in the U.S. economy as our trade partners do the same thing. So as an example, for Canada and Mexico, if those go on at 25% next month, then and stay on for 5 months, that's a problem, right? If the Chinese tariffs go on, and they're already on, actually, I think we've already increased them to 20% from where they were under the Biden administration. Again, over 5-month period, 6-month period, that's really going to start to drag on consumer spending overall because it's going to raise the prices for goods coming into the country. So that's problematic for the Fed. It's really tough for them to get a grip on what the president's doing. Obviously, that's one of the biggest challenges. and we can talk about that in a little bit. But as far as the outcome was, I think what helped the markets a little bit was the fact that the Fed said, look, even with the tariffs, we're not sure what's going to do to the economy. On an inflationary standpoint, it's a one-time shock to inflation. In other words, you raise price levels and then that's pretty much it, right? So from that standpoint, I think the market said, oh, okay, so it's not a consistent thing that's going to keep going on and on and on and up and up and up. That means that the Fed would not have to adjust their interest rates to maybe keep them higher for longer than they normally would have. So it's a mixed bag in there, but it really underscores the uncertainty that the Fed has when it's looking at the future path of policy from the Trump administration.
Yeah, it is interesting you say it. This morning, I'm trying to remember exactly what the headline was, but Axios, I think they said, our summary of yesterday is that it is no longer the Federal Reserve's economy, it's Donald Trump's economy. And it was something along the lines of that, which I thought was really quite interesting. So I guess I'm curious from your perspective, we label you an economic futurist. So it's already the beginning of April. They signaled two more rate cuts. Doesn't really leave a lot of time for those. Do you think they really happen? Do you think it stays flat the rest of the year? Or do you think they're way off base and we actually end up seeing rates go up?
Yeah, great question. Let's start with inflation. To me, the Fed's never going to reach their 2% target anytime soon. So the Fed has to make a decision of what they're comfortable with. I'm worried that they say, 2.5 is fine. We can cut again, even though they have tremendous uncertainty over tariffs, which are inflationary, even though they say it's a one-time shock. So my guess would be is that if they're correct about unemployment going up to 4.4%, then we'll definitely see 2 rate cuts. And that's hard to say. We know that there's a bunch of government workers that are hitting the unemployment lines, right? We know that's already happening. The thing that people have to really start to parse out is, what does all this uncertainty being generated by the Trump policies that are out there, what does that do for businesses and consumers? How do they look at it? And right now, what we're seeing from sentiment surveys is that it's very negative. Businesses don't know what to do with this. Anybody's in construction, and that's a wide range. I'm talking from wastewater projects to electricity to multifamily homes. How can you tell what your cost of goods sold is going to be, right? Your material costs. If you're importing soft lumber from Canada, is it 25% higher or is it not? If you're getting cement from Mexico, is it 25% higher or is it not? That's the problem. And so when that starts to occur, there's a couple of things that can happen. You can bid on projects to do things, but you have to have an escalation clause in there. And how much that is, I don't know. And that's really where we get just so much uncertainty. So what do people do when they're uncertain? Nothing. They don't do anything. They sit back and they stop spending. And that's the danger of what's going on right now. So I'm concerned about this, but I do think, in looking at Trump, let me kind of give you some high-level ways of looking at him, because I think it might be a little bit helpful. There's 5 things to keep in mind, right? Number one, he uses economic leverage as a primary tool. We're talking about tariff sanctions, trade deals, whatever. So that's what he wants to get at. And that's where things get complicated, because he has an end goal, but he doesn't give you the method of how to get there. So it's really sloppy. He has a lot of zero-sum thinking. He thinks there's one pie, and he thinks the United States should get more of that pie, where in reality, I think, if you have an ever-expanding pie, that's good for everybody. So it's a very different kind of approach. He believes in personalized diplomacy. When he gets along with somebody, that's great news for that country. If he doesn't, that's bad news. And a good example of that is really Zelensky. Obviously, they had a blow-up in the White House. That was not a good thing for Zelensky. And President Trump put a lot of pressure on him to agree to a ceasefire, which he's done now. The next thing is disruptive and contradictory foreign policy. That drives everybody nuts, right? Again, this is this unknown path to where he wants to go to. And then finally, basically the way that Trump operates is he just thinks as a contrarian. If the elite smart people in the country say do X, he does Y. So that gives you kind of a rounded way of looking at the president and how he's trying to approach what's going on in the country. You know, he really wants to do things in the best interests of the U.S. He wants to move businesses back to the United States. He feels trade deficits are bad for the U.S. And so it's just a very different mindset for how to approach running of a country like the United States. So try to keep that in mind when you're looking at him and what's happening.
That's actually really good perspective. I'm curious, given everything you just said, specific to real estate and multifamily, what your thoughts are, because I think I could go one of two ways. I could think if people are hunkering down, you know, to a certain extent, maybe this is good for apartment buildings. People are going to stay. They're not going to move. They're going to keep paying their rent. Everything is fine. On the other hand, I don't know if people are feeling shaky about the stock market. Are they going to pull their cash and think about putting it into something like buying a home? I mean, like, what does this mean for real estate?
Right. So the first thing I would say about interest rates is higher for longer. We're never going back to 0% interest rates. Well, I hope not in my lifetime, because that would mean some really bad things are happening. So here's a pop quiz for everybody. What's the 30-year average for the 10-year long bond in the United States? The yield on it? It's 4.5%.
I was going to say 5.
Today? Yeah, 4.3%. So we're about the long-term average. So that means mortgage rates and availability of money is going to be priced basically off that. So try to keep that in mind. Now, there's problems with a lot of people buying homes for the first time. I believe the average, what is it? Let me make sure I get this straight. The average annual income needed to buy an average home in the United States is $124,000. The average income today of an American is $79,000. So that is a massive gap. I believe that's the longest or largest gap we've ever seen. So what does that mean for multifamily? Well, obviously, people will not be as likely to buy homes because of that big gap. They're much more likely to rent homes. So in that sense, it's a good thing, right? That's helpful for the industry overall. And there's some other things that are really good helping the industry from a regulatory standpoint, because everybody's trying to get their heads around how do we build more housing, right? I mean, I think that's the question. We if you do your homework and you look at what's happened since 2008, basically, given the population size, we have underbuilt in the United States of about 500,000 homes per year since 2008. That is a tremendous amount of demand that's just not getting fulfilled. And if you think about affordability, which is what I was just talking about, like prices have gone up, the cost of money's gone up, and incomes have not kept pace. So it's just very difficult for people to buy single family homes. So that drives demand for multifamily housing. The other thing that's happening is states have woken up to the problem of NIMBY, right? It's the state and local zoning laws that have really made it difficult for multifamily housing, right? They just, people who own single family homes don't want it moving in next door to them. But they want to have bars and restaurants and the people that work there. Well, guess what? You got to have housing for those people. And so what's great is that the state of California has changed their laws. The city of Minneapolis has eliminated I believe they're the first city to end single family zoning by allowing duplexes and triplexes and whatever plexes on single family lots. And I think that's the step in the right direction. That's where we need to go when it comes to really alleviating some of many of the obstacles that are out there for building more housing units in the country. Yeah,
I think that's great. And actually, it's interesting. You take us right into the next question that we have for our audience. So audience, please do answer the survey here, which is what policy area do you think is going to have the biggest impact? And so, Andy, I think you jumped into some really interesting background on things that are happening all over the country. I actually remember I was living in San Francisco, and I think might have been in Oakland or Berkeley. It was somewhere in the Bay Area in a very small pocket where they actually passed laws for the first time where you were able to build a secondary unit on your property. And that was something that had never been allowed before. And, you look at areas like New Zealand, where it's one of the single biggest ways, right, that they tackled affordability was by increasing supply. And for every one home, building anywhere from 2 to 6 rental or for sale units there. And it made a big difference. So I'm interested to double click into this a little bit more. Let's see what the audience here has to say, if they're mostly concerned about rent control, zoning, tax incentives, or affordable housing issues. Let's see what we've got here. Tax incentives for development. And so, Andy, I think that's an interesting one, because I think people are saying, hey, if you give us the incentives and you can make this business pencil, we will build more housing. Does it surprise you that most people picked that one?
No, everybody wants money.
So free money is not a shock.
So exactly. That doesn't surprise me at all. But hear me out on this. How about free land? And this is something I wanted to share with this audience. Yeah, well, you may be getting it. So many people are freaked out by what's going on with the Trump administration, and I totally get it, right? What is important to understand is that there's positive things that are going on that you're probably not hearing about, because you hear about, like Venezuelans getting shipped off to El Salvador, and people getting caught up in that who are innocent, right? I mean, that's what gets blown through the media. What you missed was likely the op-ed in the Wall Street Journal this weekend from the head of HUD and the head of, I think it was the Bureau of Land Management. I'll think of the other group. But they wrote an op-ed saying, we want to make available federal land for housing development. Now, that is huge. And I really think that it brings about so many wonderful opportunities that I think will be fantastic, because that's one of the key issues. Now, it's not perfect, right? It's not great for every area. I mean, if you think about states that have a tremendous amount of federal ownership of land, and thinking about like Nevada and Utah, those are states that are going to benefit significantly from this. So they're going to make land available for building. Now, some of that land is close by major cities, some of it is not. And that means that there's going to be a tremendous amount of infrastructure build out that needs to get done. But, again, Nevada, Utah, California, and Arizona are states that which there's a lot of federal ownership that could be put into use for land. Now, I don't know exactly how they're going to do it and what the costs are, but basically you're opening up a tremendous resource for people who want to build multifamily and solve this problem of affordable housing. And it's something you probably missed it. But I can pop in, if I can get into the chat, I'll pop in the Wall Street Journal's analysis of this. And I want everybody to read it, yes, because it cuts across, it's identifying federal land. It's looking at transfer and lease land, capabilities for local entities. It could sell land to private developers. They want to streamline reviews and approvals. That's, getting rid of some of the red tape. From a federal standpoint, you can't change state and local stuff, right, from the Fed standpoint. But boy, if it's on federal property, you sure can, right? And so they want to adjust some of the zoning regulations. We'll see. They still have to work with the state regulators and the state officials. But obviously, this is the opportunity that is out there for everyone. So to me, this is one of the most exciting things that's happened in this space overall that can get to the heart of affordable housing, and that is reducing one of the big costs, and that is the cost of land.
That's actually a great point on land. And so I think this slide just speaks to regulatory concerns, which is, I think, what we're talking about now. It's interesting when we talk about the increase in supply and ways to increase development. Some of my friends at Apartment List, they're a rental marketplace, so they have a lot of data on what's happening with rents and renter trends, where they're moving, where they're renting. And I had them provide me with some data for our conversation today. And one of the things they shared with me that really stuck out to me was that of the markets last year that had the highest volume of multifamily permitting, they also saw the highest decline in rents. Now, I'm not an economist, but that makes sense to me that if you increase supply, prices will come down. And that to me is a basic law of supply and demand. Yet so many of our regulations and so many of our politicians don't seem to have policy ideas that go hand in hand with the idea of increasing supply. So I'm curious, does it surprise you that the increase in multifamily permitting led to a decline in rents? And if it didn't surprise you, why do you think there's such a disconnect?
Yeah, that's a great question. The big question too, when you talk about like regulations, is why does anybody try to do rent control? Why? Like historically, all the studies that are done on it tell you the same thing. If you limit the prices, you limit the availability or supply of housing. It's not one-to-one, but it's darn close, right? I mean, basically, you disincent people from building projects that create more housing because they're limited in the prices that they can charge. And they're not allowing the market to bear what it can and fluctuate based off of that. So when you get more supply, more permits being done, right, it makes a lot more sense that the prices would come down somewhat or stabilize because you've got more supply coming on the market. We know there's a lot of supply that's been coming on the market for multifamily. So I guess to some extent that the surprise is that we haven't seen more price depreciation overall, because there's a ton that was built. I'll just give you an example locally in North Carolina. I'm around Charlotte, and there is massive building going on all around the Lake Norman area. Like, you cannot believe, and in Charlotte itself, but it's everything Charlotte and north of there. And that stuff is starting to come on. So you're starting to see some prices ease up. And that makes perfect sense. The thing is there's just high demand. So it's a question of, look, as multifamily owners, yes, you want to get as much as you can for each unit that you have, but you also have to understand the dynamics that if prices keep going up, you price out everybody. And so that's a problem overall for the country. And so this is a way for supply to come on the market that, will stabilize prices overall for people. And that's something that needed to get done. So no, and answer your question, it's economics 101, basically.
It's funny. I've always felt the same way. I'm not an economist, but it has always made sense to me. And I'm somebody who spent most of my adult life in California in rent control areas. And I've seen the impacts of it, and I've never understood it. Which actually leads me to my next one. So again, I had my friends at Apartment List give me this data. I found some of it interesting, and I'm curious your thoughts. One was on migration trends. So their data is showing what I think we already know basically hasn't changed. People are still leaving California. People are still leaving New York. People are still leaving Illinois. And people are still flocking to Texas, the Carolinas, where you're from, in Florida. So there's a part of me that sits back and says, the classic tagline, it's the economy stupid, like what we just talked about. People are moving to areas that are more financially affordable. But I'm curious, from your perspective, do you think there's more to it? And do you think that this migration trend is going to continue?
Yeah. So the Census Bureau did something really cool, and it's a little creepy, basically. They studied the internal migratory patterns of U.S. citizens from the summer of 2020, when we had COVID, to last summer. And hopefully they'll keep this going for a while. And what did they see? Exactly what your friend described. 2.1 million people moved to Texas over that time frame. California lost 500,000 people. As an example, Illinois lost people, New York lost people. And that move from north to south is really been part of that dynamic. Yes, it's some retirees, but you have to remember, and this is why it's important to have context and understanding what's happening today. You kind of have to go back to COVID, right? And during COVID, I lived in Illinois at the time, and they did crazy things in that state, crazy in the sense of really poorly managed public policy. I'll give you an example. in the city of Chicago, right, they didn't want people interacting with each other. And so you know what they did? They actually put snow fences up around the parks. Now, you have to understand that is the dumbest thing ever, because you want people going outside, right? You don't want them to stay inside, huddled together, right? And it creates a lot of mental health issues as well. So eventually people broke down the snow fence, but that's part of the reason why, it's part of the reason why I moved out of Illinois. But, we went down to North Carolina, and it was like that state did not shut down. South Carolina did not shut down. Florida stayed open the entire time. Texas pretty much, and Arizona as well. So when you think about those things, that's really key. That accelerated that migratory move from the north to the south, because the north stayed closed, and they threw on all sorts of crazy regulations on people that weren't helpful in the sense of dealing with COVID, I believe. So just a funny example of this, so when we moved down to North Carolina, we moved down in the spring of 21. So we move out of Chicago, everybody's wearing masks, everybody's staying away from each other, 6 feet distance and all this stuff. We go down to North Carolina, and we're renting a townhome at the time. And just down the street from us is an open air concert venue. So my wife goes, why don't we go there this weekend and see what's going on there? So we go there. Remember, we just came from Chicago. Everybody's huddling, in their, basement or whatever with masks. We go there. Everybody's outside drinking beer, no masks whatsoever. And my wife and I are like, should we be doing this? Right? This is crazy. But that's the point, right? So that's the difference. It's one of the reasons why Ron DeSantis was quite popular in Florida for a long time, because he kept the state open and running. So yes, your friend is spot on with migratory patterns. Part of it, as I said, is the baby boomers retiring, but also part of it is the housing affordability capabilities in places like North Carolina and South Carolina. The land is cheaper, and the rentals or the build out is cheaper than it is in the north. So that's also contributing to it as well.
So before we move on to everybody's favorite topic, which is next, which is AI, let me ask you one more question about migration trends. I'm curious your thoughts. So we tend to see, speaking of COVID, that during COVID and beyond, suburban real estate market saw higher rent increases than we did in urban core, right? Which makes sense in COVID. People were leaving the urban core. They were headed to the suburbs. You were able to get more space, less money, right? All the things that everybody wanted. Well, now we know that all these companies are making everybody come back to the office. And this idea of work from home is very quickly going away. I am curious, what do you think the economic impact is going to be with the return to office policies, and how do you think that's going to impact real estate?
Well, let me just push back a little bit. Yes, a lot companies are trying to get their workers back, right? For sure. It's not happening just yet. The surveys that I've seen, you're still at 27% of the week is work from home. And what are the highest days worked in the office are Tuesday, Wednesday, Thursday, right? Not Friday and Monday. And also I think there's a tremendous amount of flexibility for people, because number one, we've learned that you can do it. Number two, we've learned that you can do it pretty efficiently and with the technology that we have. And so for people that have children, this is really important, because that's one of the problems of having a child is not so much dropping them off at school, it's picking them up at 3 o'clock, right? And so I think flexibility is the key for most companies. Yes, there's a lot of groups that are trying to force their workers back in the office. Maybe they'll get there, maybe they won't. If you look at Castle swipe card numbers, they're still in the 60s as far as a percentage of people coming into the work. So, and you can say, well, look, that doesn't quite capture everything. That's true, but it's not a bad indicator. So what I would say is this is a process to get people back into the office. It's not, everybody's back in full school 5 days a week, 8 through 5 or whatever it is. I don't think that's the case. It'll be a slower process. They'll continue to push that way. But where do you see that? Well, you can see it in commercial real estate ETFs, especially if you're New York City, they've rebounded significantly. And on the opposite side of things, and commercial ETFs for like medical facilities, those have gone down significantly since 2022. So there is kind of an adjustment that's going on for sure. So I would say slowly but surely, like we're looking out at the suburbs, once you go out there, like, especially if children, there's not a rush to go back into the city, to move back.
You don't want to go back.
Yeah. So, but there are forward-looking cities like, I would say Dallas has done a really good job of looking at redeveloping, office space into living space. But as we all know, that's a really expensive thing, is, the layout of an office is vastly different than the layout of, a living space. And I was down there making this point,
Sure.
I think it was about 2 years ago, to a bunch of developers. And they said, that's true, Andy, but, it all depends on what you buy the property for. So if you get it cheap enough, then the economics work. But overall, I would say right now, there's this kind of there's a lot of uncertainty about whether or not you'll really pull those people that went out to the suburbs back into the city as much as people hope they do. All the rental people in the cities want that to happen, but it's going to take time.
I agree. Well, I think this is a perfect time for us to segue to talk about AI, because of course, there is no way that I was going to let you get through this conversation without us talking about the hottest topic that everybody wants to discuss. So we have another poll here for you, which is about barrier to adoption of AI. So for all of our multifamily operators out there, I am very curious of how you are approaching AI. And then if you all don't mind, I am going to mute for 1 second because I'm having a little bit of a technical difficulty. But Andy, what I would love is, while I do that, can you share for the team here kind of the most unusual or most interesting thing that you have used AI for this year that you could share with the team?
Sure. So one of the things I do is break down I's. There's BI, which is business intelligence. There's AI, which is obviously artificial intelligence. And then there's Gen AI, or GPT, general purpose technology AI. That is your DeepSeeks, that's your ChatGPTs, your Groks, you name your AI. And there's a difference between the three, obviously, but the artificial intelligence is really important from a number of standpoints. As you're looking at your businesses, we talked a little bit about like preventative maintenance, making sure you're getting data. You're taking a model and you're teaching that model what you want out of it. And then you start supplying that model with data and allowing that model to tell you what the data is telling you and give you forward insights into the business. That could be on how many times people go in and out of a door. It could be your HVAC. It could be an elevator, right? That's important to keep up on maintenance. So that's really important. And then you kind of get into Gen AI, which is a very different animal. The way that I like to describe it for audiences is that it's like a really smart young person who's trying to, impress you with their vast knowledge of things, but you got to double check their homework, right? So sometimes they'll bring things in that maybe are not appropriate or correct. So I think that's the way I frame Gen AI and GPTs overall. In answer to your question, here's something I think you should do, and this is really fun to do. When we're looking at growth opportunities, as an example, what I like to do is let's pick a big builder or somebody who's in the multifamily space that's publicly traded. I don't know, pick a name. Right. And so what I do is I pick that name and then I go into a ChatGPT or name your thing. And I go, over the last 5 investor calls investor calls, what has company X said about their growth opportunities into the future? Huh. And so
what a great tip. By the way, any salespeople out there, be listening.
Yeah, and so what is company strategy? Company X's strategies for growing into the future. Bam, it's right there for you. Now you got to double check to make sure that that's kind of what they said a little bit, but then you can go, okay, I work at company Y. How can we either do what they're doing or take advantage of what they're doing or find a way to either sell to them, or how can we compete with them? Bam, it gives you strategies right away on how to do it. Again, you have to look at them to see if they make any sense. But this is what I'm talking about when it comes to GPTs overall. And that is, they can make your people more productive, more efficient at what they do, and give them a lot more insights at their fingertips so they can be more aggressive and forward thinking about how to address competition in the marketplace.
What a great suggestion. And I will tell you, as a CRO who manages sales organizations, I am going to take that because that is a great suggestion. And I love that. So let's see what everybody here said. We have, looks like 26% worried about ROI and cost benefit, which I think this goes back to the earlier question, right? Is if I can't show an ROI, I'm not going to do it. I think the internal expertise, that's fair. You launch these things, but if nobody actually knows how to get the most out of it, this one I do think is really interesting because I think people tend to forget, us being in the multifamily industry, these are brick and mortar buildings that human beings live in, right? And so, technology needs to be brought in to enhance that experience, not replace. You can't replace human beings living in your building. So I think that is a great point that people bring that up. I guess I'm curious from your perspective, you see a lot outside of the real estate space. What do you see companies using AI for that you think could potentially be relevant for this audience?
Well, dynamic pricing is really interesting way to do it. Yeah, that's surge pricing, right, to some extent. And personalization, I think that's really important too. I think it gives you the opportunity to adjust prices depending on what the demand is. And I think that's also really helpful. You have to be careful about it because if you constantly adjust, then that throws consumers off and they don't know, they'll feel cheated if the price goes up when they're trying to sign a contract or something like that. So you have to be a little bit careful about being too overly reliant on that. But I think it's important. That's one area that I think is pretty cool. You don't want to ignore the human interaction capability of this. And actually, that's really important too. It's a combination of both. It's both AI and human interaction that matter, that can be enhanced. So you want that to not disappear anytime soon. But you also want to be able to personalize, some of the resident engagement. What is the client interested in knowing? Can you supply that to them? Can you send them an email on, I don't know, like daily activities in the area or restaurants or, go down the list. There's a whole bunch of things, or when the rent's due, little reminders like that. So, just to enhance and help them, I think that's some areas that I think would be really important for people to get their heads around. Now, there's some pitfalls too. You got to be really careful about data privacy. That's one thing that's really important. You're basically where, you're in the space that people are living in. And so they don't want their privacy invaded from that standpoint with a lot of cameras and things like that. Some are necessary, but, that's important. But also, making sure that you build a moat around your AI so people can't hack into it and download people's data, so you don't have to send people's emails, or you don't have to send people emails saying, we got hacked again. All right, that's not good. People aren't going to like that. Renters aren't going to like that. But those are a few examples that I think are interesting when it comes to AI.
Yeah, I think that's a great point. I know it's something we take really seriously here at SmartRent, because I think going back to, we are talking about residents living in their homes, right? And it's a different ballgame. Somebody had shared with me something I thought was interesting, and it goes hand in hand with things that we're working on here, which is predictive analytics. And somebody was telling me about, those big giant wind turbines when you're driving down the freeway, right, that you see. And imagine when something happens with one of those and they break, right? Who's the company that you call? How long does it take them to come out? And then what does it take to actually scale one of these machines, physically scale it, right, in order to fix it or replace it? And they've built predictive analytics into the turbines that essentially take in all of these data points, from the age of the turbine to the speed of the wind that day to the temperature. And there's all these data points. And then essentially it spits out like, hey, we think we're going to have a problem at a certain confidence level with X number of these. And so you're able to be more predictive and proactive around maintenance in these, which can lead to a ton of cost savings. And so I know here at SmartRent, we're looking at industries like that and going, okay, how can we also build predictive analytics for exactly the same thing, right? Which tells you when things are going to go wrong in the physical asset before it does. Because there's so much savings that can happen there. So it's just fascinating to see the pace at which this is happening and what you're able to do with it.
Yeah, so it's exciting times because everybody can get a lot more efficient. You can also get signals too. Like all of a sudden, if like heating is kind of like if your heating bill seems wrong, right? And then, depending on what you're structured at, like if something's going on there, you can, call on unit 3 and say, hey, what's going on? Or did you leave this on? Or, you know what I mean? Water is another good example of that. So, I think there's a lot of upside to this. And I'm sure there's a lot of companies out there, I can't name them right now, but in this space who, obviously are going to be able to create the pathway to get that data information for you, whether it's sensors or however they're doing it, so that you can see the ROI and see the savings that you have, plus getting rid of some headaches, like getting the phone call at 2:00 in the morning because somebody's stuck in an elevator, right? Nobody wants that. So I think that's part of the benefit of this technology.
Absolutely. Well, we're getting close to the end. We want to make sure that we answer some questions. But before we do, I think, we've talked about economic uncertainty. We've talked about tariffs, inflation, interest rates, and all of this can just feel really scary, right? We don't know what's about to happen. And we want to end on a positive note. So we want to ask the audience, and then I'm going to ask you, Andy, a similar question, which is, what are you most excited about with regards to the future? So I would love it if the audience out there could go ahead and answer. Is it innovations around resident experience? I know a lot of people are talking about how do we make the resident experience great and how do we retain people? How do we make operations more efficient, right? We all want to be faster, smarter, better. What are emerging markets? I mean, you start talking about things like opening up federal lands, right? Like, what does that open up in terms of markets where maybe we didn't have opportunity today? And then for multifamily, is it just the resilience of the industry? Because there has been a lot thrown at us over the years. It is a resilient industry. So I'm curious to see what everybody has to say here. Andy, any thoughts on what do you think our audience is most excited about?
Or what they should be excited about. Well, I don't want to.
Well, that's what I'm excited to hear.
I don't want to skew the survey, so maybe we should let them. There you go.
Yes, because I am excited to hear from your perspective, because I could see as an economist, you might be terrified about the future, but I'm sure there is stuff happening today that you are excited about.
Yeah, so let me just talk about being terrified, right? So my big thing is overall, I see opportunities all the time, especially from difficult situations. And I think anybody who's either managed property or has been, in charge of anything knows that you learn a lot when bad things happen, right? And that's, if you can get through that time, you can say to yourself, if something bad starts to happen again, I know how to deal with this, right? I've been through that cycle. To some extent, a little bit, that's what happened during COVID, obviously. So I skew towards more optimism than pessimism. I see things like, doing virtual tours, whether it's real estate overall, but also, in your buildings, showing people, obviously with drones and whatever, that's huge as far as efficiency goes. You don't have to let somebody in the apartment. They're going to want to go in there anyway, but you save the time of the initial, foray in and out of the building. That can save you a person a day, right, from doing that. That's a lot of money when it comes to labor costs. there's just a lot of, I think, virtual leasing. I mean, just the facility of the paperwork. There's a lot of positive things like that. But overall, we have seen, and taking a step back, we've seen a surge of immigration in the United States, right? We know this is one of the reasons why President Trump came into power, because people were upset with that. Having said that, that's a lot of people demanding a lot of housing, right? And maybe not all of them are, legal. Maybe they're undocumented. Fine, but the demand's there, right? And we need workers, and we will continue to need workers going forward. People want to come to the United States. Whether we let them in or not, that's a good question. But there will be demand going forward, and that's good news overall. So I think for this sector, you may not be getting the rents that you get right now going forward as more supply comes onto the market. So start to anticipate that occurring, but also begin the process by which you can implement technology in a way that gives you the ROI that makes you more efficient and more productive. So, right now, like we just haven't built enough. So you're probably doing great. You've probably made a ton of money with the units that you have, but start planning for a different environment going forward, because eventually we're going to solve this issue, and there's going to be a lot more units coming onto the market.
Well, I think that's a great perspective. And I love that you mentioned we can always learn from difficult times. I hadn't really taken it from that perspective, but I remember being in this industry, in the crash of 08, 09 was when we started to see tons of buildings being handed back to the bank, right? And that was something that I had never experienced in my career, where you would actually see, apartment buildings go into foreclosure. And I think, to your point, the banks learned from that, right? And so when you look at now, where we're coming up on a very similar situation, right? You have a lot of owners that bought properties when interest rates were low. Now they're trying to refinance. Interest rates are higher. On top of it, you have inflation, increasing interest costs. I mean, all of the things that are causing expenses to go up. And then you have this big debt service increasing. But what we're hearing, at least from a lot of our customers, is that the banks are very much more willing to work with the buildings and figure out creative ways to refinance these so that we don't have the big crash that we had in 08 and 09. So I think it's an interesting perspective that part of the optimism is around everything we learned during this time is going to cause us to do things differently when it happens again in the next 10 to 15 years, which we know it will, right? I mean, these are the cycles. You see it all the time.
Yeah, well, I would just say this, that we're not going to have like a financial crisis like we saw in 2000, 2008, 2007, 2008 anytime soon. Banks are extremely well capitalized. The consumer is pretty well capitalized as far as their own balance sheets. Now, a lot of it's at the upper end for sure, but 0% interest rates. There's a lot of people that took advantage of that. Right? Myself included. I'm never selling my house. I have a 3% mortgage. That's never going to happen. I'll die in there. But I think that's what's really important. So when you see all this doom and gloom out there, yes, it's very difficult right now. All of your costs have gone up. Insurance costs have gone up significantly. Material costs have gone up significantly. Labor has gone up significantly, for sure. And if you have to refinance, well, then that's a problem too, because if you only thought that you were going to get, 3% on the mortgage again, and you got a 5-year adjustable, well, that's a problem, right? You have to start planning for these things and getting ahead of it instead of, hoping and praying that something will come out of the blue to help you. But that's part of the process, right? It's part of learning how to manage these things through challenging times. And then when you see something like that again, you take full advantage of it and you're ready for it. So it's all about preparation, right? So that's what's key for being successful going forward in this space.
So I am curious, we're getting to the very end on Q&A. And of course, anybody, please ask any questions if you have them. Otherwise, we will answer one question that we have here and then send everybody off on their day. Andy, I am curious specifically with regards to the rental markets. Are there key economic indicators that people should be watching to get an idea of the health of the industry?
Well, I mean, the unemployment rate's a good one, but it's a lagging indicator for sure. And so even though we're up from the lows, it's still not bad. look, if you go to anybody in Europe and say, hey, what if I said that unemployment would only be 44% and you have 1.7% growth? They'd be like, oh my gosh, it's a boom, right? So, I mean, the U.S., we're navel gazing a lot and thinking that the worst is always around the corner, and it's not. But I would say, you do have to pay attention to, if you want the best economic indicator, the most forward-looking indicator, it's weekly jobless claims. And those have not risen significantly until you start to see those things consistently shoot up to like 250, 275, 300,000. That's when things might start to get a little bit dicey. Here's a really good thing. If you really want to stay on top of GDP, obviously that's also important too. You can just Google this, the Atlanta Federal Reserve GDP now. You can just Google that. It'll bring you to that page. What's nice about what the Atlanta Federal Reserve does is that they give you a real-time look at GDP. This is not like this is how the Commerce Department puts together that model. And as pieces come out, they input it, and then they tell you where they think GDP is going. It's pretty accurate. Right now, that's showing a negative number. Like, oh my gosh, we're in a recession. No. Like, people don't wait around for policy to happen. What made this negative is this, right? So it's the old model of GDP. It's C plus I plus G minus X. Well, X is imports. And if people believed Donald Trump that he was going to put 25% tariffs on goods, they front ran that, and they decided, well, we're going to import a lot before those tariffs hit. And that's exactly what they did. So we saw a big surge in imports, which takes away from GDP. So it's not necessarily that growth has gone down. It's just that imports have gone up so significantly. But I like that page. I really want people to keep an eye on it. And it does kind of detail why it's going up and down in there. It will tell you why. And I just think if you're trying to stay on top of things and you're trying to cut out a lot of the noise that's going on, that's a great page to take a look at.
That is such great advice. Thank you. And I know we're at time, but we have one more question that I think is fantastic. And separately, I'll say for anybody that has to jump, again, my name is Natalie Cariola, SmartRent. You can connect with me on LinkedIn. I know somebody has a question there specific to SmartRent. Feel free to email me, Natalie@smartrent.com. I'm more than happy to answer your specific questions around SmartRent. But Andy, while we have you here, I have one last question that I think is really interesting, which is around Fannie and Freddie. Do you anticipate the possible release of Fannie and Freddie from conservatorship? And do you think it's going to have a major impact on lending?
Yeah, I would say this government has done so many different things. This administration has done so many different things that we never thought was possible, especially with Doge, right, and Elon Musk. So I would say there's a really good chance that they're going to take a hard look at getting these people out from underneath the promise of the federal government. Now, it goes beyond that, right? So you're talking Fannie Mae, Freddie Mac, and Farmer Mac. There's a whole bunch of these GSEs that are out there. So what does that mean? Well, basically, they have a risk premium to them that's lower than other banks because they are supposedly backed by the federal government. Well, they also are the critical, they buy most mortgages, right? Let's bottom line, right? So if you take away that aspect of it, what will that do to the mortgage market? Well, that's a good question. I'm not sure. That'll raise interest rate costs. That'll raise more costs of buying a home because now you've introduced uncertainty, and you'll probably have to have those organizations have capital set aside to deal with uncertainty and deal with bad times. So overall, that would definitely cause a lot of confusion and chaos within the mortgage market. Not good overall. So we'll keep an eye on it. There's a lot of things the Trump administration is doing that aren't good for the economy overall, and creating more uncertainty through Fannie and Freddie and whether or not they can be GSEs anymore. That would add to it.
Well, that is great insight. That was such a good question. Andy, thank you so much. This was such great insight. Everybody out there, thank you for joining us. I hope you got a lot out of this. I'm going to go ahead and end the event now. But again, I just want to say thanks to everyone and enjoy the rest of your week and weekend.